Hi, everybody. I'm Michael Episcope, co-CEO of Origin Investments. I'd like to extend a warm welcome to everybody on this webinar today. We have both existing and prospective investors joining us today. And this is the IncomePlus Fund update webinar. And my co-host today is my partner and friend, Dave Scherer. He's going to take the second half of this. And then we're both going to do the Q&A together. Dave and I, we used to do every webinar together, and now it's more likely one of us and a senior team member. And we do that for divide and conquer, and then also to give opportunities to our senior team as well. And for you to get to know them, that's always a good idea too. Today, though, is a unique webinar, and we have a special announcement that is best delivered from the both of us. And you may have noticed the theme of this webinar. It's time to go on offense. That's a new message. And the entire presentation is dedicated to talking about why and how we are going to go on offense. And I'm going to cover the fund overview, including valuation and performance. And then Dave is going to go over the macro environment and also talk about market opportunities. Our portion of the presentation, it's going to be probably a little bit longer than usual, maybe around 40 to 45 minutes. We'll try to keep it to that. Hopefully we'll get a little bit under. And then we will open it up for Q&A and stay as long as we possibly can. We appreciate your questions. We will answer many that were emailed in during the presentation. Thank you so much. They help us shape the presentation as well. And if you have more throughout, please add them into our Q&A, and we'll get to those at the end. I already see some coming through now. So let's begin. Why go on offense today? And the simple reason is Dave and I have been doing this long enough to know that the best time to go on offense is when sentiment is at its lowest, also while fundamentals are improving. And this is what's happening in real estate today. And I want to really highlight two things that are evident and have historically been great leading indicators. The first, investor sentiment. It's definitely at its lowest level we've seen in 15 years. This is a risk-off environment, and that's really when you want to be investing, not when things are priced to perfection like they were in 2021, but when there is an imbalance in your favor. And capital flows are sort of indicative of investor sentiment and also market tops and bottoms. And capital is most plentiful at market tops and most scarce at market bottoms. And capital flow in our market, in the real estate market, has come to a screeching halt today. Now, sentiment by itself doesn't mean anything. There has to be a catalyst, a reason, something on the horizon that will improve the fundamentals. And that can come in a lot of different forms. Dave is going to cover those in great detail. One of the biggest fundamental changes I see in the market is the Fed stance. The Fed has been the headwind for real estate for the last 3 years, but they've not only indicated they are done raising rates, but have also indicated lower rates on the horizon. Now, that has been tempered. It used to be 6 rates. It was 3. It's still an incredibly restrictive policy, even if they lower it 3 times, but that's the general consensus as we're looking out into the future. And they will get inflation down. And there's a saying, you don't fight the Fed, you want to be on the same side of what they're doing. So when they're restricting policy, you don't want to be in front of that. And when they're easing it, you actually want to have those tailwinds behind you. And if it's not the bottom we're at, we don't pick tops and bottoms, we do believe we're close to it. And that's really when you want to start building a position in the market. And so how are we going to do this? Well, first, we are going to start with raising $100 million in dry powder. And in order to do that, we are providing special terms to both existing and prospective investors. And here are the terms. Anyone investing in the fund between now and October will not be charged an asset management fee and will not pay carried interest through the end of October either. On November 1st, your capital will be converted to the standard share class, and you'll begin paying fees at that time. And this is really what we call the free rent period of investing. And the purpose is, yes, to spur demand. And the other reason is that it's going to take us some time to deploy the capital into the market, and we're going to be disciplined and very diligent about what we invest in and when. And I want to be clear, though, that any capital that is invested through this program will be invested in the fund's assets. It will be diversified across the portfolio, and it's going to generate a return from the day it goes into the fund. And so it's actually a very beneficial return. You're going to generate around 2 to 3% more on an annualized basis than in the standard share class. And that's just math. You're removing fees from the equation, so you're almost getting close to the gross return. The minimum investment in this program is $100,000, and this is only for new investments as well. It's not retroactive to old investments. It's not to increase investments. We're only taking it in increments of $100,000. And we're creating these special terms because we need a war chest of capital, and that's essential to go on offense and to compete and find opportunities in today's market. This next slide, it shows the life cycle of the fund's portfolio makeup since inception in 2019, and really how we've performed across all cycles and the decision making we've made over the years. And it illustrates, you can see how we've tactically managed the fund across cycles. So the graphs that you see, that's the makeup of the fund across debt and equity. And of course, equity is a combination of both core plus and ground up development. And starting on the left-hand side, it shows the fund in 2019. We had a 70-30 mix of equity and debt, much more weighted towards equity at that time. COVID came along in 2020, which is the trough you see. And we generated around a 1.7% return that year. And I should note, 2019 was not a full year return. That was a partial year return. But as we started to come out of COVID, we were mostly positioned towards equity, 70% in equity, and we generated a return that year of 22%. And what also happened during that upswing is we made the decision to begin shifting towards defensive products. We invested in preferred equity. We allocated capital towards ground up development to protect basis. It was what we called our barbell strategy at that time. And really the last built deal we've acquired, we haven't acquired one in 4 years. That was in March of 2020. In 2021, you can see our strategy starting to take place, the shift begin. And it was, we went from 70-30 to 60-40. It was still favoring equity that year. And in 2022, it was around 50-50 balance across debt and equity. And I think what's also interesting about 21 and 22 is it was the opposite of where we are today. Sentiment was at an all-time high. Capital flows were at all-time highs as a result. Deals were priced to perfection, trading 30-40% above replacement cost. And there was a general euphoria in the market. And not surprising, that also signaled the top. Now, by 2023, our portfolio was positioned for the air that was about to come out of the market. We were 60% debt, 40% common equity, and our strategy worked. It paid off. 2023 was arguably one of the worst markets we've seen since the great financial crisis, and we still managed to generate a 4.5% return that year. And we're certainly faring better than others in 2024. We have a positive return this year, and there's some good things happening in the portfolio as well. Now, this strategy and this mix and this makeup, it served us well during this period to sort of dodge and sidestep the 23 and a lot of 24. But what worked well in the past is not necessarily the best strategy in the future over the next 3 to 5 years. And all the way to the right is where we see the market in late 24 and through 25, really continuing its upward trend. This next slide is really just focusing in on where the portfolio is today and where we envision it by the end of 2025. So the fund is just shy of around $500 million. We're right around $480 million in fund asset value. So these shifts, they don't happen overnight. We have to talk about them, plan them, do them well in advance. So how do we do this? How do we manage to shift almost and flip this in the opposite direction? Well, number one is the capital we raised this year, it's going to be deployed into common equity deals in really one of two ways. We'll either invest in high margin ground up development opportunities or opportunistically acquire existing deals. This isn't going to be business as usual that we're putting money into 14% preferred equity. It's a great opportunity. This is really our opportunistic capital that we're going to be looking to make 18, 20%, 22% IRRs over 2, 3, 4 years. And to me, this is actually a perfect time to invest in ground up development because we will be delivering 2 to 3 years out into a market with little to no supply. So don't, be surprised if a lot of this capital goes into ground up development. Our return on cost today, 6.25%, 6.5%. We still think it's a great way to protect capital, to grow wealth. And we want to see that bucket that we call kind of the frontier bucket always maximized at 20% of the portfolio so that it's delivering the jet fuel that the fund needs. The second way is that we're going to be acquiring roughly $92 million in sidecar interest over the next 12 months. So for those of you who have opted into our sidecars, the terms of those that after development, prior to stabilization, we will be acquiring those investments. And you have the choice of either rolling it in to the fund tax-free or taking cash at that time. So these positions, though, they are accretive to the fund because they are being acquired in what I will call a depressed market environment. You either want to be a seller in a market or a buyer in a market, and we would much rather be buyers in this environment today. And they're also being acquired, as I said before, prior to full stabilization. So there's a little bit of meat left on the bone on those deals. And lastly, we have somewhere between $200 million and $280 million of preferred equity paying off between now and the end of 2025. And that money will either be redeployed into new debt deals or common equity deals. We can make those decisions in time, and we have the tools to shift the allocation and stay agile, even in a fund this size. So it's not difficult, but it takes planning and discipline. And we wanted to let you all know what we're thinking and where we're at today. And, let me go back to the previous slide. The last thing I want to touch on here is the distribution yield. It now stands at 6.15%. We did increase it at the end of last year. We've increased it every year for the last 3 years. And that yield, it's largely been delivered tax-free, tax-deferred, however you want to say it. And while that yield, it doesn't jump off the page, you might say, that's only 1% more than I'm getting in the bank. The reality is that the taxable equivalent, meaning what you'd have to earn because you pay taxes on anything you have in the bank, that would be closer to 9%. And to me, that does jump off the charts. Now, we do have some taxable events coming up as our preferred equity rolls off, but we believe, and we've done the math behind this, that we're going to be able to continue to deliver the yield in an extremely tax efficient manner by using accelerated depreciation to shield any income that the fund realizes. So I'm going to cover the last thing is valuations by bucket. And this is 3 slides. We essentially have 3 buckets here. And then I'm going to hand it off to Dave. And we get a lot of questions. And the big one is this, like, why hasn't the unit price gone down? I've been waiting for the unit price to go down. And it's a really good question. And there's always nuances to every fund. The reality is that certain parts of the portfolio, they have been marked down and marked down pretty significantly. But other parts have done quite well and have more than offset those markdowns. What you see in front of you here is the preferred equity part of the portfolio. And this part of the portfolio, it serves to protect the portfolio while also delivering what I would say are very healthy returns. 63% of the fund's capital is in preferred equity today. And we're sitting kind of an average between 58, meaning that's where the senior loan comes in at about 58% LTV, and ours run up to about 78% on average. Now, these are well-protected positions. Collectively, they produce around a 13% coupon rate, but we do have 3 positions that exceed 90% LTV, so we've stopped accruing them in the portfolio. And our valuation policy requires us to do that. Now, so essentially, the $280 million is generating a return to the fund of around 10.6% today when you take those three deals out of the equation. I want to be clear, though, just because we haven't accrued the interest doesn't mean we won't get paid all of the interest. That's actually what I would say is potential for upside in the fund. These are high quality deals. The equity still has value in these deals, and we do think that there is potential for these deals to be paid in full, not only the principal is not at risk today, but all of the accrued interest. And these are also potentially part of a pipeline. These are high quality deals that we'd be excited to own, certainly at our basis if we could, but we're already in there and we're talking to the sponsors, and we could be a buyer and that could be a use of our funds. So it becomes almost a proprietary pipeline for us. Ground up development is another bucket of capital within the fund. That makes up around 18% of the fund today. And this portion of the fund is valued right around $80 million. And it's expected to stabilize closer to $100 million. And that is using a 5.3% terminal cap rate, which we believe is easily defensible based on recent trades. You can find trades that are at 5 caps. You can find at 5.25. We cannot buy deals at 5.5. We're trying out there good quality deals. They're just not trading at that level. So we have this marked at 5.3, which is a really attractive price that you would be buying into the fund as well. I want to make a point when it comes to valuing the funds. These deals, they actually have been written down significantly from their original projections. When you value ground up development in an open-ended fund, you incrementally recognize the value as you get closer and closer to stabilization. So if you have a deal that costs $80 million and you believe it's going to be worth $100 million in 2 years, you don't write it up. You don't keep it at $80 million until you've stabilized it, and you don't write it up the day you put a shovel in the ground. You write it up incrementally towards that $100 million over time. Well, if the $100 million becomes 90, you write it up slower. If it becomes 120, you change the slope of that curve. So that's kind of a nuance that you need to understand. And in an open-ended fund, you're buying into the assets based on how they're currently being valued. That's what makes up the unit price itself. And so the terminal value of these assets has been written down significantly, and anyone buying into them would be buying in at the value of $80 million with an expected value of $100 million using a 5.3% cap rate. So we will be trending towards that $100 million. So there's still a lot of value to be had, even buying it in the ground up development deals, buying in today, even though they're very close to stabilization. Soon enough, over the next 12 months, we will be moving these into the core plus bucket, because that's what happened. We build ground up and then they move into the core plus, and then we'll be reloading the ground up development and investments to maintain that 20% max capacity that were allowed by the fund documents. The last one, this is the core plus. This part of the portfolio makes up around 19% of the fund. It provides cash flow. The properties deliver around 4.8% cash on cash to the fund today. They also provide millions of dollars in tax benefits every year through depreciation, and they provide potential for upside. This is common equity that you're investing in here. They're actually levered on an incredibly conservative basis. We're only at 53% loan to value in this fund, and a lot of that has been because the assets have just appreciated at a constant debt level. This part of the portfolio is valued at a 5.3% cap rate, so very almost exactly identical to the ground up development cap rates. And I should note, it's not a big part of the portfolio, 19%. And one of our largest assets in this portfolio, it has 30-year HUD debt, and at an interest rate of right around 3.25%. So from a valuation perspective, this asset has largely been immune from write-downs, as the debt has actually increased in value significantly because it's a bigger piece of the asset than actually the common equity itself. We've certainly written down the other properties, but they don't make up a huge part of the fund, which is why this has not adversely impacted the unit price to maybe the point that you would expect if it were like true common equity. So there's nuances to it. Just wrapping up this portion of kind of valuation, it comes down to math. When you think about it, 2/3 of the portfolio is generating around a 10.6% return to the fund. 19% of the portfolio, the ground up development, is somewhere between 12 and 15%. And the core plus part of the portfolio, it's sort of, -5 to -7%. So you still get to a positive fund return even after fees. And I believe in the fund valuation. I believe in the strategy of tilting this fund towards common equity. I think this is the right time. I know Dave agrees with me. I like the outlook. I like the upside in some of the opportunities, even within the fund. And we're putting our money where our mouth is. We're both investing another $1 million into the fund this month with you. And so we already have a significant amount of our wealth in this fund, and we're adding to it because this is a great time to do so. So with that, I know that was a lot. I'm going to hand it over to Dave at this point, and he's going to go over the macro and talk about some exciting opportunities in the market. Dave? You're on mute. There you go.
So nice to be back on a webinar with you, partner. So I'm gonna jump right in. I was in Seattle and San Francisco last week, actually, meeting with investors. We have, I think, close to 4,000 investors, not obviously only in this fund, but across our funds. And it was really, really nice to meet people in person. And many of them, said, "Oh, you're the person from the webinars," which was interesting. We're in such a hybrid world now. It's really nice to meet people in person, and hopefully we'll meet more of you. We're doing live events in Houston and Austin next month. I know Michael's been to many of them as well. One of the questions that I kept getting, and I already see in our Q&A, it's an extension of that, is what's the better investment, strategic credit or IncomePlus? And it's a very good question. We get it all the time. I would approach it in two ways, and then I'll jump into my slides. One, just as in the equity and bond market, your investment advisor probably has told you this a lot. Long term, you want to be in common equity more than debt. It's a longer term wealth grower. In real estate, it's also much more tax efficient. Michael was talking about the difference between our dividend of 6.15, which really acts like 9, if you were comparing it to a taxed investment that you would need to get to generate the same post-tax. So one is tax efficiency. The second is IncomePlus, because we can be agile and we're going to start moving the portfolio more to equity. We haven't done that in 4 years, but we believe long-term you want to have more exposure to equity. Historically, it's outperformed on an absolute basis, not to mention a post-tax basis. So that really is my answer, is if you're after returns long-term, this fund should outperform strategic credit over long periods of time. Right now, the credit market's providing great opportunities, and we're excited about strategic credit taking advantage of those. But that's also cyclical. And there'll be other environments where it's not as lucrative in credit, but it's much more lucrative in equity. These are long-term investments, and they should be approached as long-term investments. Okay, why do we like the fundamentals? Because what we're seeing, both on the ground, but also through Multilytics and the data that we're collecting, operationally, rents have begun to turn around, and they're going to continue to do so. And I'll take you through the why. The first is our demand. So the demand for multifamily housing continues to grow because people are rational actors, and it's just much more expensive to buy a home right now than it is to rent an equivalent home via rental. That shouldn't be surprising. I actually saw an economist today talking about mortgages. He said 90% of the mortgages in the U.S. are below 6% and 80% are below 5%. The mortgage rate is 7%. And whether you own a home and you're thinking about selling it, but you don't want to trade in your 4% mortgage for a 7, or you're trying to buy a home and you're realizing you just can't get enough home based on your income and what the mortgage rates are, et cetera. The other thing that was really interesting is last month, 33% of home transactions were all cash, which again is shocking if you think about it. People buying have the capital and they're not using debt. That excludes most of your buyers from the market. That's why there's so few transactions with little supply. There hasn't been a home correction yet. Maybe there isn't going to be one. But the spread actually continues to widen. This data will look even more pronounced next month than what you're seeing here of 1,000. So that rational acting, there's just more renters than buyers right now. The drop in supply is speaking to the multifamily drop in supply. And, if you can see 2024, that's where we are today. That reflects an enormous amount of supply that's in the market today. But what you have to keep in mind is, depending on the data you're looking at, we're underhoused anywhere from 4 to 7 million homes or rental units. And I know that's very wide. There's a very wide dispersion of data that I see. So let's just pick the lower end, 5 million. That's not going to be cured, because if you look out in 25, 26, 27, you're going to see this precipitous decline in new housing supply, and in particular multifamily. That's what we're doing. And that doesn't surprise us at all. We're one of the more active developers, certainly in our regions, Southeast Texas, Southwest. We are just seeing almost no new supply, and that really started 6 quarters ago. So this isn't a new thing. We've already lost over a full year of supply in 23, and in 24, it's not getting better. And so what you're going to find in 25, 26, 27, we're going to be able to raise our rents quite a bit. If you're in municipalities that have these housing shortages, you're going to see this growing sentiment towards affordable housing and getting the local municipalities involved, and people are upset. Like, that's all coming. So I want to be on the right side of that. We will see the ability to raise our net operating revenue in the next 2 years, which is the fundamentals of our industry. We often only talk about supply, but we don't talk about absorption. And so that's what's interesting about this statistic is, these are all the areas we're covering and investing in. And this will just confirm sort of what I'm saying is as supply starts to come down, and it will, the demand doesn't. People are still moving to Texas. They're still moving to Charlotte. They're still moving to Nashville. They're going to need housing, and it's going to put upward pressure on rents that we'll benefit from. And that's why we're trying to re-enter the development market. As the developments we have come online, we want to start on new ones. We think that's going to be a very good vintage that this fund will benefit from. On the distress side, we do believe that there's, an opportunity that's going to be happening in 24 and 25 because there's lots of debt maturities coming due. We get this question a lot. I already see it in the Q&A, so I'll address it. Distressed assets, let me back up for a second. Origin is very experienced in distressed investing. Fund 1 and Fund 2 were entirely distressed. And so I don't want to say we've done every form of distress, but certainly deed and lose, foreclosures, restructurings, bankruptcies. We've done all of these and done very well doing that. However, the reason we've waited so long to say now it's time to go on offense, we just didn't see the distress that was showing up in the potential distress that was showing up in the fundamentals. We didn't see it actually happening. And so we don't want to raise a fund or raise a strategy and not have deals. We are seeing distress now, but it's in assets we don't want to own. And so these are, 70s, 80s vintage, lower quality assets, lower growth rates, lower quality areas. We've been very proactive about leveraging our feel, our local market knowledge, our people who live in the cities we cover, and Multilytics to determine the assets we want to go after. And they're not there yet, but we think that there's a very good probability they will be. And the lower quality assets are starting to trade in a distressed manner. I'll also say that if you're seeing opportunities in distress, I have not seen the types of returns that you want for distress yet. They're not bad. They're kind of 12, 13, 14% returns that are tax efficient. That's not exciting to us. Michael covered this. We want upper teen returns, 17s, 18s, 20s. That's what we're holding out for. And we think there's a good probability of that happening. You've seen how patient we are. We haven't bought an asset in 4 years. I mean, it's when we decide to do something, we execute. So we'll be patient here as well. There are opportunities in development to achieve those types of returns. So we'll start there, and then distress, we'll be patient. But if it happens, no one is better positioned in our markets than us to take advantage because we're prolific in equity and debt. We see both markets. I mentioned this already, but both the boots on the ground and importantly, Multilytics, our machine learning platform, is predicting a bottom. We're bottoming right now. And there's actually very strong rent growth predicted, in particular in our markets, which corrected first. I'll just pick one, Phoenix. Phoenix was one of the first markets to correct. It had negative rent growth last year and really sort of led. And it's also going to lead us back out. The fundamentals haven't changed. People are moving to Phoenix. They want the lifestyle, the low tax. Industry is moving there. Tremendous job growth. You're going to see that turn around in the next year. We're not going to be 100% right all the time. We have been 100% right for the last 3 years. And so when I say Multilytics is predicting this turnaround, it predicted 21, 22, and 23. I'm confident it'll be right in 24. We'll see. And one of the things that is a core value at Origin is we hold ourselves accountable. We publish our results, what our predictions are, and we write an article every year. And then we grade these predictions. And so we'll continue to keep you apprised. It's been very accurate for the last 3 years. We believe that we're buying things on or towards the low. And these are some examples of the types of deals we'll be targeting. So many of you are in Denton. In fact, an investor at our Seattle meeting, it was a dinner and a meeting, asked about Denton. And there were delays in Denton caused by the city. But we're on track. We're going to be starting in May, late May. So, these are the types of things we can't control. That this is what development brings, but we really like the return profile, kind of upper teens that I'm talking about. Similar altitude at Brooks, San Antonio. And by the way, IncomePlus owns a small portion of Denton now. Altitude at Brooks, this is actually a qualified opportunity zone deal, but again, upper teens types, gross returns. And then distress, to be clear, I don't have a distressed deal to show you right now. We're looking for Class A investments in our markets with strong future rent growth at the right price. I think that this fund, it will be the only fund that capitalizes on equity investments in distressed deals. So this is a question we get all the time. Is there going to be a growth fund 5? Are you going to have a distressed fund? No, it's going to be called the IncomePlus Fund. we have the full ability to change the strategy. And Michael, spent a lot of time on this. To be clear, we're changing the strategy. We have not focused on equity for 4 years. We were right about that. It's our opinion that it's time to start looking, both in terms of long-term growth and tax efficiency. Like, this is the time. So distress will fall here. So I believe that's my last slide, Michael. I tried to be efficient, but I do agree with what Michael said. We'll be investing $1 million each. We already are significant investors in the fund, because it sort of answers every question. Like, do we think this is a good opportunity now? Yes. Do we think that the fund is fairly valued? Yes. Why would I invest if I didn't? And all of those questions sort of are cut through by that action. You want to lead us in Q&A?
Yeah, I'll do that. So we'll just tick these off one at a time. We've got question number 1 by Rob. Have you seen any signs of distress yet in any assets you wanted to buy? Rob, I think Dave already answered that. The quick answer is no, we haven't. Not in what we're looking for. Could it happen? Yes. But I also, I want to say, distress is a matter of perception, I think. And I'll just use an example. If the market is trading at a price of 100, I'll just use that, right? Distress is defined as buying an asset at 80. And if it's trading at 80, then you want to buy something at $60. And sometimes the whole market is just in imbalance. And that's what you have to look for as a manager. Because if we go back to 2008, 9, 10, that period, we were in that camp. We were always looking for a huge edge to where the market was. But the reality was the whole market was distressed. And as managers, I think that's something we've learned over years, is to recognize when there's an imbalance and when there's an asymmetric return profile, and buy high quality deals at a fair price in a distressed market. And you're going to do very, very well.
Question from Lily. Thanks for the question, Lily. Are we seeing valuations go down or the rate of the correction slow down in multi? What's interesting, Lily, is from an operating metric standpoint, we've bottomed, meaning rents aren't going down anymore. Operating expenses have stabilized. I think they're poised to actually increase. NOIs will increase point forward. From a valuation standpoint, because that incorporates both operating metrics and multiples. We call them cap rates, but multiples. There haven't been a tremendous amount of transactions, but most of them are at or below where we're valued. So simply put, Michael was saying that our development and our common equity investments, and even our pref, when we do that valuation, is largely based on a 5.25 cap rate. We're seeing anywhere from kind of a 4.9 to a 5.15 type cap rate environment of transactions that are actually happening. And so we're a bit conservatively valued relative to what's there. I'm comfortable there. Anything you hear, and you do hear things like, oh, well, this traded a 5.5 or whatever. Not to our underwriting, not the way we underwrite, maybe the way someone else does. We can take their deal and the 5.5 becomes a 5.1 because we're more conservative about, rents, operating expenses, other income. There's many things that change. So I would say short answer, valuations have stopped going down. I believe OpEx is stable and rents are about to go up. So I think we're closer to the bottom at this point, which is obviously why we want to shift the strategy.
Blair asked the question about interest rates, and he doesn't believe interest rates should go lower. The question is, if the Fed does not lower rates, do you believe that multifamily is still attractive now? Blair, I want to differentiate between multifamily and this strategy because we will continue to be agile. And as we get information going forward, if it doesn't look like the Fed is going to lower rates, there are still great opportunities, especially in the debt side. And we always reserve the right to be wrong. You're not going to pick the exact bottom, but we do believe that this is the time where you have to start building a position. And I will tell you that there are always unintended consequences of the Fed's actions. And if the Fed keeps interest rates higher for longer, then when you're looking out into the future, like, you're going to have even more rent growth and real estate investment performance kind of going through the roof, because what they're doing today is really shutting off the spigot for new ground up development. David went over that slide about the supply, and it's just deteriorated significantly going out 25, 26, 27. And if rates continue to stay higher for longer, you're going to have less and less supply in the future, which is only going to exacerbate the housing shortage in this country. So it is complex. We don't know what the Fed is going to do. I'm not stating an opinion. Like, when I say that the Fed is going to lower 3 times, this is based on the polling of the Fed governors. I believe that they probably know better than anybody. And even if they bring it down to 4.5%, it's still incredibly restrictive compared to where inflation is today and where it's been historically. So it's a little bit of a wait and see, and we're just relying on what we see in the future. But obviously, things change and will change with them.
We have a question from Gulzar. I apologize if I didn't pronounce that correctly. What kind of ground up development will IncomePlus be doing? Well, that'll vary by market, but generally we're doing either garden or wrap or podium. But what we don't do is high rise. We don't feel like you get paid for the risk of that construction type. Also, operating expenses are a bit higher, which we believe hurt values. We're also going to be focusing quite a bit on build for rent, and we're doing that across all of our funds. We think that that's going to be an enduring, differentiating type of construction. There's just a lot of people that we believe want to buy homes but can't. So the build for rent gives them a substitute product that feels and they can experience the feel of home ownership without owning. So you'll see an awful lot of that, both in IncomePlus and our other funds, QOZ, et cetera.
Dave, I'm going to grab 2 here. The first one is easy. Ross asked the question, do existing fund investors need to invest an additional $100,000? Yes, Ross, that's how the program is designed. It's a minimum of $100,000 to qualify for that share class. And then Brian asked the question, is the monthly dividend currently completely covered by cash flow? The answer to that, Brian, is yes and no. The monthly dividend, about 65% of our investors opt in for the drip. So if you're looking at the portion, if you took 100%, the answer would be no. If you're taking that 35%, the answer would be yes. And that's the part of our liability that we really look at, is how many people actually want income from the fund.
We have a question from Manan. Is now a good time to sell single-family rental homes to invest in IncomePlus or a qualified opportunity zone fund? That would be our third OZ fund. I'm not able to answer that question, but I will say that single-family rental homes, if you're using that as a rental, a lot of the times people use them for their own personal use and rent them. But if it is a rental, that can also put it into a 1031 category. And we are launching a 1031 program at Origin. So that's another option. QOZ is an option. 1031 is another tax deferred option. So if you have interest, we're happy to talk about that, but it has to be a specified rental home, that not a hybrid. That's the only thing that qualifies for 1031. Do you want to take the next one, Michael?
No, it's from Manan. So why don't you follow up with him there?
Okay. Where do you see the trend being for property taxes and insurance? I touched on this before. I think that on the expense side, we're going to start seeing normalization. I'm not suggesting that they're going to go down, but I don't think that you're going to see shocks like you did in Q4 22 and last year. I think they're going to start to grow at a normalized rate. We use between 3% and 4% in our models. I think that will be accurate going forward. But I don't think that if you're in, in a market where insurance is a lot, you can expect it to go lower. I think that change has happened. Property taxes will be interesting because valuations aren't up. And so it'll be interesting to see how the cities approach values that are flat to even down in many markets, what they do with that. Because if they keep the mill rate constant, the taxes should actually be going down. Local counties generally don't want to do that.
Ramil, and apologies if I don't pronounce your first name correctly, asked, will there be sidecar deals with the Common Core and development assets? Definitely for the development assets, potentially for the Common Core, depending on how big they are, if we find some distressed assets, certainly, and those are always offered to our fund investors first.
Last question. Love all these questions, Manon. This is great. He has a question about rent growth for Austin and Houston. I wouldn't answer a question like that, but what we can do is give you the 40 or so submarkets that we independently map for those cities. You can't, in my opinion, and Origin's opinion, you can't take a city and say rent growth is this. Because many of the submarkets will grow quite a bit, others will be flat. But we're happy to share all of Multilytic's submarkets for Austin and Houston with you, which I think you'll find very valuable. Incidentally, we'll publish all this for everyone too, back to being accountable.
Robert, I'm not sure if you got your question answered. If you can resubmit, I'm not sure what that he asked. Is this measuring rent growth or returns? Maybe that was during the presentation. James asked, you mentioned sidecars coming due. How much of these sidecars will be due in 2024 and 2025? James, I don't have the exact number. I know that collectively they're 92 million over the next 12 months. So hopefully that answers your question. We can get you the schedule. If you're in any of those deals, that should have, that was expressed to you when you entered, when we would be buying those out in which month.
Please keep sending your questions. We've been very efficient. This is the last question. So if you have more, please just keep sending them in. Kevin, are we expecting sidecar opportunities in IncomePlus going forward? Or will the 100 million in new capital be enough to satisfy your pipeline? I don't think that this will be enough to satisfy our pipeline. That's, again, my opinion, and it's predicated on market conditions and the quality of deal flow we see. Like what you've seen is our willingness to be patient, our willingness to not put growth ahead of returns and risk-adjusted returns, and protect and grow is the strategy. And this fund has done that. I think that, if the market presents itself the opportunities, you're going to see sidecars. The 100 million won't be enough.
Chris asked the question, how many dollars in redemption requests have there been, and do you have a gate in addition to the 2.5% to 10% penalty? Chris, the dollar amount exactly, I don't know offhand, but we have had minimal redemptions, less than 1% of the fund's NAV. We do monitor that. And we don't have a gate on the fund, so that's never been a problem. But no redemptions have not been an issue with this fund whatsoever. And I know, many people ask because that has been a huge issue with Blackstone. I don't know if they're straightened out now, but it took them a couple of years to clean up that queue.
We just got 15 more questions, so that's great. I will answer Jeffrey's question. This is a great question. Love that you're clarifying. It's a clarifying question. If you invest today in IncomePlus, is it being deployed now or not until November? If you invest today, at the next trade date, we'll accept your capital and you'll enter the fund. We don't know if it's deployed as of day one or not, meaning invested. That's the whole point of we're playing offense. We're looking for these deals. But you as an investor will be in the fund in the next trade date, and you won't be paying fees for 6 months. And that's where the November comes in. Michael, since you covered that, I just want to make sure that I'm in agreement with everything you said.
Yeah, 100%. The investors coming in will be immediately diversified into the fund assets. we're going to be holding the cash and we're going to be investing that over a period of time. But you will absolutely generate the fund, almost the gross fund returns because of the no fee structure. Okay, Manan asks, can you speak to the extend and pretend dynamic and how it's affecting availability of distressed assets? Extend and pretend is a term used by banks where essentially they have a bad loan and they continue to extend it. And that's actually been a strategy that has worked in the past. Manan, a lot of the stuff on banks' balance sheets, like those aren't deals we would want, right? A lot of this is in the commercial side. It's office, it's retail, it's things like that. And it hasn't really impacted the multifamily market. The multifamily market is dominated by life cos in terms of lending. It's also dominated by the GSEs, Freddie, Fannie, of that. And we haven't seen it show up. Will it impact lending and what lenders are willing to do, and do they lump it together? But the kind of, what we'll call distressed assets, we're looking for high quality assets that are distressed via a capital structure. And a lot of the assets that we've seen out there, they're distressed because they're just, at the property level itself, they're just not good quality assets. And so haven't really seen it affect us, but there is a wave of maturities coming that should put some pressure on the market and provide some opportunities.
Great question from Benny. How are increased affordability requirements for new developments impacting investment decisions between new developments and value-add deals? So where we focus, for example, in Texas, there are programs called PFCs and HFCs that do require affordability as part of your, typically it's 30 to 50%. But in exchange for that affordability, you get a 99-year abatement of all property taxes. And in Texas, property taxes are your largest expense by far because the state doesn't have an income tax. They have to raise revenue somehow, and it comes through property taxes. It's inordinately high, 2 to 2.5%. And so we're actively looking for deals like this, and you also want to look at deals where the affordability or the median income is very similar to the market rent. And so there are really interesting opportunities within this affordability. But like if you're just saying, well, in the city of Chicago, no matter where you develop, you don't get a tax credit, but you have affordability issues, that just shows up in a lower margin deal, and we won't do it. That's why we don't cover Chicago. Many reasons we don't. But it's city by city. Sometimes it's an opportunity. Some of the cities in Texas, for example. Another example would be Colorado Springs. We did 3 deals there because of local property tax waiving initiatives that made them more viable. So sometimes we gravitate towards it, Benny. It depends is the answer.
Dave, I'm going to jump to question 19 by Jeffrey. I think you've already answered question 18, but take a look at that. Jeffrey asks, aren't you concerned about construction costs? Aren't they still quite high with regard to inflation? They are high, Jeffrey. They're leveling off. And I think one thing that has really changed is that the volatility of construction costs has waned quite a bit. It used to be that you could get construction pricing on Friday and it would be changed by Monday because things were going so crazy. So we have seen a leveling off of the prices because of the lack of demand in the real estate side. So it's much easier when we're looking at deals, but it really comes down to the math because construction costs are one variable when we're looking at a ground up development deal, and it's looked at against the revenue side of the equation. So you have a cost and revenue and your net margin on those deals as well. And ultimately, we're going to be looking to develop at a 6.25, 6.5 return on cost. Certainly, if construction costs kept going up and rents didn't go anywhere, then it would be nearly impossible to do deals. But with rising rents on the horizon, it looks like they're going to actually be rising faster than construction costs.
Yogesh asked a question. Do you allow existing IncomePlus investors to add money to existing accounts? If yes, what is the minimum? Great question. The minimum to get this fee waiver of 6 months, where we waive all fees, is $100,000. So if you're an existing investor and you've already invested $100,000, it would require another $100,000 to get that fee discount. I hope I answered your question.
John asked a question, or had a request. Please provide details on the existing IncomePlus assets on your watch list. Absolutely, John. Just email me or David. My email is michael@origininvestments.com. Anybody can email us and get an update on those, and we're happy to share those with you.
There's a question from Chris. If the market is picking up, are you looking at cap rate compression going forward? Chris, no. In all of our models, whether it's a development or a new acquisition or distressed, we always model in cap rates going up. It's traditionally, historically at Origin, it's been a 10% cushion. So like, in other words, if we believe that, we're using a 5.25 to value our portfolio, then if we're doing new deals, then, after 3 or 4 or 5 years, we're kind of assuming a 5.5, 5.6 world. Obviously, cap rates could go up or down from here. We don't know that, but we always price in that conservatism. That's also why when I said earlier, if someone is showing you a distressed deal saying, hey, look, these are these huge return possibilities we have, et cetera, you really do have to get in the weeds, not just on NOI and how they get there, defensibility of inputs, but also things like what's their entry and exit cap, how are they getting to that? They can make enormous differences in what you're looking at.
Rob asked the question, are you doing any short-term rentals in your current portfolio to drive more NOI? Rob, that's on a case-by-case basis. We had some short-term rental companies, certainly during COVID, but they're not all they're cracked up to be. Sometimes they're a distraction to just running it as you would under normal conditions. We're always evaluating innovative ways to drive revenue, but in the past, when we've sort of cordoned off a certain amount of units for short-term rentals, it hasn't been a great experience in that case.
Leander asked a great question. Does Origin Multilytics account for a recession and its effect on property values? No, we don't do that, Leander. That's not the goal of Multilytics. What Multilytics is doing is taking in billions of pieces of data a month to answer one question, which is, what is future rent growth? I should back up. What's current market rent at a property, and where is it growing in year 1, 2, and 3? It's been incredibly predictive at one thing. And so, no, we're not using Multilytics to try to predict a recession. We don't use Multilytics to try to predict construction costs, insurance costs. It's one thing, and it's very accurate at predicting our revenue.
Georgia asked the question, what are your thoughts on BFR in Austin, Texas? That's very specific, Georgia. I don't know if you're looking at a deal down there. We like BFR a lot, favors the demographics. It's a true substitute to home purchasing. And in terms of Austin, Texas, right now, it's oversupplied. It has some challenges, but it all comes down to the individual submarket, the deal, the economics and stuff. So it really, I hate to say it depends, but it does depend.
Brett asked a question, if Origin can build to capitalize on housing shortages, why wouldn't other private and public groups do the same? And then, solve the shortage, if you will. And the answer, Brett, is it's very, very hard to get deals that pencil, and even harder to get them capitalized with debt and equity. Because Origin is viewed as very experienced, we've been developing across 5 different funds, over $1 billion of development, and we're very respected as a developer in our markets. We have access to debt and equity that others wouldn't. And so all of the kind of marginal groups that get capitalized when the market is very forgiving in terms of debt and equity will not get deals done. And that actually really adds up when you eliminate less sophisticated groups from the equation. Carlisle will still develop, and they will be a competitor. But the 10 regional groups that don't have infrastructure experience, access to debt and equity, they actually won't, and that adds up quickly.
Rob asked the question about the percentage of payouts by year subject to current tax versus tax deferred. And he's talking about the distribution yield, I believe here. Rob, I believe last year, 100% of the distribution yield came back tax-free, tax deferred. I think I have to use that word. And then I think the year before it was 95%. Now, you should know, and I alluded to this, that we do have taxable events that happen when our preferred equity rolls off. But because we are rolling a significant amount of deals into that core plus bucket, what happens when deals go from ground up construction, stabilize, you can start depreciating them. And what we are also going to do is when they come into service, we're going to use accelerated depreciation to offset, all or almost all of the taxable events that's happening as our preferred equity pays back in those situations.
We have a question from Rob, and Michael, maybe you can answer it. He wants clarity on the $100 million share class raise versus the normal share class. Can you take them through that again, please?
Yeah, and let me answer Robert's question too, because I asked him to resubmit that. He said the slide from way back, 4 to 6% CAGR. Robert, that was rent growth in the markets. Those weren't IRRs, so that's what we're talking about with respect to Multilytics. Rob asked, can you repeat the 100 million share class benefit versus normal share class? And it only goes through October and then converts to base share class. Correct. If you invest today in April, you will have a May 1st trade date. On May 1st, you will go into a special share class where you don't pay an asset management fee of 1.25%, and you do not pay our carried interest of 10%. So essentially, depending on how the fund does, that can be equated on an annualized basis anywhere between 2 and 3%. So your money, though, will be invested in all of the assets, just like everything, and you will enjoy those benefits for 6 months. If you invest in April, if you invest in May, you'll only have 5 months. If you invest in June, you'll have 4 months, and so on and so forth. And everybody at the end of October will then convert to the normal share class. And I should mention that we're also waiving admin fees for that special share class as well. So it's a huge perk to investors. We're serious about building a war chest. We think having capital in this market is way more important looking out on the horizon than some short-term fees. And we think a lot of people are in our camp and really see the opportunities in the market and are thinking like this. And that's the basis of the program and why we're doing it. So hopefully that answers your question.
I'm going to answer Gaurav's question, how we manage cash drag with the fundraise, and then maybe you can answer Scott's about K1s. Yeah. So Gaurav, great question. One of the ways we'll manage it is we'll identify investments to put them in. And so that mitigates it. The other is we have a very preferential return on cash, and it's FDIC guaranteed. We get 5.5%. So that's where the money will be. It'll be earning 5.5% while we're looking, obviously, for much higher returns, which we believe are going to materialize. But back to Michael's point, you don't raise money in a fund when you quote need it, especially not in distressed, because distressed happens quickly. Not the idea of it being distressed, but if a lender wants to move an asset, they will call us. We're very wired in, but you have a week or two to move. It isn't a typical transaction. And so if in that week or two we're trying to raise the money, that's not tenable. It doesn't work. And so it's the best option we have by far right now to develop capital that we can leverage in those directions for long-term growth.
Jay Scott asked, why are K1s late this year, and is that a permanent change? So K1s, I don't remember what the latest email said when they're expected, but we are waiting for K1s from the property level, and you can't even begin the fund level K1 until you have all the underlying property levels, and those have just been delayed for reasons, I don't want to say outside of our control. These are our partners, but we weren't able to get them in time so that we can deliver the K1s by March 15th, which I believe, or April 1st, which was our previous date. Scott, it likely is a permanent change here, giving everybody that guidance coming in. As the fund becomes more complex and has more deals, it's more challenging to get the K1s out. As a small fund, when you only have a few deals, it's a lot easier, but I would expect that as an investor. Now, something we have been discussing internally, and this could happen in the next year, is converting this fund to a 1099 structure. And we are going through understanding the legal of that, understanding the ramifications to investors, but we understand people prefer the 1099 structure. You can email me. I'd love to hear your thoughts on that. We understand this is a pain point for people. So thank you for the question.
Benny asked a question about mitigating insurance costs. Is your portfolio on your target markets facing increased insurance costs? It isn't. Like I said before, insurance changed in terms of its pricing for a lot of reasons, and we've covered this, but I'm not going to cover it again. But I think that going forward, it's going to be a normalized growth rate. I don't think there's a risk. And importantly, the portfolio valuation that Michael is going over and the share price reflects the higher insurance. That's all in there. Do I believe that you're going to see another shock like we did? I don't. I think that was a one-time event that now will be replaced by, and to be clear, I also said I don't think insurance is going to go down. It could, but that's not my opinion. I think it'll just grow slower.
Let's see here. Kevin asked the question, if I put in $100,000 now and I want to add more before November, do I have to put in another 100,000? The answer to that is no. Kevin, you've already met that minimum return threshold. So I'm not sure exactly what our return, I think $25,000 increments once you meet that minimum threshold.
I believe this is the last question. Brian has a question about development. The 6.25%, 6.5% return on cost was mentioned as what we're trying to solve for new development. Can you explain the math and how is it affected by interest rates? So Brian, when we're looking at these deals, we price in interest rates as they are today and the future interest rate curve, which is the Eurodollar curve or the SOFR curve. So right now, we don't believe we're smarter than the SOFR curve, so we plug that in. That SOFR curve's moved quite a bit. In December of last year, they were expecting 6 to 8 rate cuts. Now consensus, Michael said, is around 3. So in other words, our models now are pricing in higher interest rates for longer, and we still have to get that 6.25%, 6.5% return. What will the actual borrowing rate be over the next 2 or 3 years? I'm not certain of that, but I do know that we're pricing in 5.25% to 5.5%, which kind of goes down to 4.7%, 4.5% over a 2-year period. Like that. That's what our developments are assuming, and we update the SOFR curve on a weekly basis in our models. So I hope that answered your question. If it didn't, Michael talked about reaching out to him. My email is david@origininvestments.com. You can reach out to me as well.
Dave, I'm going to take this question. Jay asked a really good question. Will existing investors be diluted by the $100 million of new capital flowing into the fund? Great question, Jay. The answer is that existing investors benefit greatly from $100 million of new capital, because think about, if we are able to deploy $100 million into the fund at high margin deals that are generating 18, 20%, you as an existing investor benefit greatly from that, even if you don't invest in this program. So that is, again, that's part of the, that's almost 20% of the fund that is generating extremely high returns. And you're going to benefit from the acquisitions of the sidecars, the conversion of this preferred equity and everything. So there's a lot of good things happening. We've thought about this, and this is good for both existing investors, the program, if they want to invest in this, and new investors and investors who don't want to invest in this at all.
That is all the questions. 39 in all. We answered every single question. I'll give you one more chance if anyone wants to ask one more.
Chris asked the question about, Chris had the question about 1099. He said 1099 would be great, but then you need to get them out by February. How is that possible given it's still based on property data? Chris, that is a very astute question, and that is exactly the question we are trying to answer here and figure that out from an operational perspective, because clearly February 15th is way before, but others do it with much more complicated structures than we have. We know it's possible, and we will find a way.
So one last question. Gaurav is asking if we would invest in distressed value add deals. We have lots of experience in value add investing. We haven't done it in about 5 years. We thought it was overvalued and risk adjusted, not where we wanted to be. For the right asset at the right price, we would take a look at it again. We're certainly good at doing it. It would have to be real estate that's functional in a barrier to entry market with great affordability ratios, the types of things that produce long-term returns. But I will never say never, because we're very opportunistic in what we do.
Dave, I'm going to take the last question and then you can sign us off. All right. Rob asks, how do conversions of sidecars work in such a way to deliver investor returns to those in sidecars versus the acquiring fund? And Rob, it's done on a fair market value basis. So there's the entire valuation policy is outlined when we're doing these sidecars and how we are going to acquire these interests. And existing investors, they actually have the ability to roll those sidecars interest into the fund on a tax deferred basis. So it's very beneficial to them as well. But we always designed this program to buy it, the deals before they were stabilized, but after development in those periods. So the investor is getting the majority of the returns for being in that development risk, and the fund is still buying an asset at a really great price.
We had one last question. Jun Bin, I hope I said that correctly. Thanks for joining us. It isn't a new fund. This is the IncomePlus Fund. But if you invest $100,000 or more of new equity, you will not be paying fees for the first 6 months. And so this is just a way for us to develop what we're calling a war chest, because we think this is a great time to start pivoting into common equity investments. So please, I'm sure that you have an investor relations contact. Please contact them. I'm also, you can reach me at David@Origin Investments, and I will make sure that you get to your person as well. Mark has a question. They just keep coming in, Michael. Yeah. Mark, great question about distributions. Will distributions be 8% for 6 months? I think you should probably handle that. I think
no, Mark, that's not how it works. We're not. The distributions don't go up because of the fees. The fee waiver, they're still at 6.15%. You can opt into the DRIP in the program, but that part doesn't change.
And then Robert has a question, you see, about does it have to be all or none?
Robert, good to hear from you. The answer is no. It can be half and half if you want.
All right.
All right.
I'm going to sign us off. If you have other questions, Michael@Origin Investments or David@Origin Investments, and we'll make sure we have 60 team members. We'll loop in whoever needs to join. I hope we answered your questions and conveyed the theme, which is this is an opportunistic time. You do have to follow capital flows. Capital right now is very bearish on real estate. Think about that. It was about 18 months ago to the day that people were very bearish on the NASDAQ. These things change quickly, right? The rate of change has never been faster than now. And so this is a great time for us to pivot. It's a great time to get in at what we believe is a very fair to underpriced valuation. We hope we answered that question too. And we hope that we showed you that we believe in both by our own investment. Thank you for your time and for your partnership. I'm going to sign us off. Thanks, Michael.
Thanks, Dave.